Welcome to Confident Compounding with Corey Kramer. Today we're going to fulfill a viewer request and take a look at NICE stock, ticker NICE. I have this one pulled up. I just noticed on the Tel Aviv exchange. It doesn't really make a difference probably for what I want to show, but I want to show the US version. There we go. Okay. As always, not individual investing advice, just how I analyze stocks. So these guys, let's pull up a description. First, let's look at the fast graph real quick. They have an excellent history of the past 20 years, from 2005 until 2025, worth only 1 year where earnings growth declined during the Great Recession. Every other year had really solid growth. So over the past 20 years, this has been a great company. Got a little overvalued here at 45 PE during the peak of the everything bubble. And now it's down. Oh my goodness. Let's just see. It's down a lot. It is down, let's call it says 65. It's probably down about 70% off its highs. Even though earnings have held up so far. So it's a pretty interesting one to look at, and I'm glad somebody asked about it. If you have a request you'd like me to take a look at, put it down in the comment section. I'll eventually get it written on the chalkboard behind me and make a video for you, and I'll either post it here or over on the free tier over on Patreon. That link's down in the description. I also have weekly picks over on Patreon as well for $25 a month, and a full service over there too. So if nothing else, go check out the free service over there, and you'll get more videos than the ones that I post on YouTube. Especially if it's like a small company, I usually post those just over on Patreon because I don't think too many people will watch them anyway on YouTube. Okay, so a little disclosure here. This is not going to be a buy, I'll say ahead of time, but I am long this stock actually. It was a weekly pick back in March of this year. So on this dip here, so near the bottom of this, kind of what I was hoping could potentially be a bottom, ended up not being a bottom, and then forward earnings, the market maybe was right about that. Well, we haven't had the earnings yet, but when we bought it, those earnings weren't looking quite so scary next year. So it hasn't, I would say it's one of my worst performers, actually, definitely one of the worst that we bought this year. But we just have a small position, so I definitely could see the appeal, obviously. But I'm going to tell everyone to be a little bit more cautious here. So let's look at what they do first. All right. So global software company, core business is cloud-based, AI-powered software platforms for customer management and financial crime, compliance, and risk. If you read through here, they have like a customer, I was going to try to use their wording here from the AI, but let's see, solutions for data intelligence, analytics, fraud detection. That's part of their business. But the other one is contact center. Yeah, so here we go. So AI-enabled platform for contact centers, handles customer service automation, routine interactions across channels, workforce engagement. So this is the one I think that is in danger, that the market's worried about from AI, obviously, I think. And even though in this description, and I'm sure if you listen to their conference call or you look at some of the information they put out, they would focus on how they're AI enabled. But I think the risk is that AI is going to be able to take away just the core business that's driving the customer service part of their business. So I think that's the risk. I don't know how big or real the risk is, but I'm pretty sure that's what the market is thinking. And I was aware of that back in March as well. But I thought I'd gotten cheap enough that it was worth taking a chance on. So it's down 30% more since then. It has a PE of under 9. But what we need to keep in mind here is, and this is why the Fast Graph is nice. I do have an affiliate link for Fast Graphs down in the description too, where you can get like 25% off if you use that link and code. If you haven't ever used it before. But this is one of those situations where you can kind of see the benefit. So we can just look at the graph, and what these dotted lines here are analysts' expectations for the next 2 years. And the main thing that changed from 9 months ago or whatever when I bought it until now is these forward expectations are now expecting an earnings decline, and that's not how it was 9 months ago. So analysts are now getting more negative on future earnings, and we'll see. And potentially management. I didn't look at what management's actual forecasts were late enough in the year now where probably their management is also forecasting some slowdown here. But if you just look at what they did this year, they actually still grew earnings 13%. So we don't know what's going to happen. We don't know what adjustments management's going to make and all that. And how these future earnings turn out will determine whether the stock is cheap or not. So now, obviously, if they were going to continue their historical trend of earnings growth, like 10% or something, maybe even better, like 12, 13%, then it's a steal, right, if they continue to do that. But that's not the expectation right now. So what I would do at this point in time, as we get more, so we can see more of the things that AI can do and how it might ultimately affect their business. I don't think anybody knows exactly how it's going to affect it. But the market but it's real, I would say. It needs to be taken seriously, at least, on the investor standpoint. I'm sure if you went and read bullish articles on it, there's plenty of bullish things to say if you just pretend like there's no risk of AI disruption, because everything else looks fantastic, basically. So, including the valuation, which is super cheap. Now, this valuation is pricing in some sort of earnings decline. Significant. I would say it's pricing in 50% earnings decline. So it's very negative. But we don't know how bad the earnings decline will ultimately be. It almost certainly will be negative next year, but we don't know how long it will go on, and we don't know how deep it will be. So I think it's better to just admit that and try to build a strategy that takes the fact that we don't know into account, but that we need to, just because it's down 65% doesn't mean it couldn't fall another 65%. It's going to depend on what earnings do. So what I would say is, even though I own this stock still, and I'm holding it to see what happens, for new money, I would wait until it rises above, the stock price rises above like the 200-day moving average. And that will potentially at least be a sign that we might be signaling some kind of a bottom, especially if future earnings growth is more positive, and there's some signal of that. Now, the market will probably suss that out first, which is why the technicals make a little bit more sense. Just like the market did this for the past however many years. Well, let's look. So at first, the market was crazy when it was in this bubble here and paid 45 PE. That's ridiculous. But at least for for 1, 2, 3, 4 years, the stock price has been going down, generally speaking. I had one little spike here. And more recently, the market has been right about the eventual earnings decline. So we need to, in situations like this, I think you need to defer just a little bit more to the market, because the people that are trading this right now, granted, there are going to be short sell. I don't know what the short interest is. When stocks get into this situation, there's going to be heavy short interest. And so they can push. Just because the stock is down doesn't mean they're right. Okay. They could end up being wrong, but I think nobody knows. So what I want to see the stock price rise above that 200-day moving average, which right now is $148 a share. That means you're not going to be picking the bottom, right? But it could save you a 50% decline. And when earnings do eventually bottom and start to rise off the bottom, there's still enough, if they can have earnings growth that goes into the future, this could still be a good long-term hold with plenty of returns left without trying to pick the bottom, right? And so that's how I would personally approach it, unless somebody has like really good industry or company specific information. If a person works in this industry and they have intimate knowledge of NICE's operation, things like that, that's fine. If a person really does that, if you're one of those people, I'm not going to argue against you if you turn bullish, but I know I don't have that information, right? So, and it looks like the market is kind of betting against it right now. Now, when these sorts of situations do turn, they can look kind of like what this looked in 2022, right? With this just V bottom. But where's that 200-day moving average thing? We'll pretend like this was a real, pretend like this was a real recovery. So maybe the market was predicting this earnings decline a year early and it took an extra year for it to happen, right? That could be what was going on here. And then the shorts get squeezed, right? And then you get this. So we can look and see that right about here, and call it the beginning of December 2024, it crossed the 200-day, right? So right about here, see if I can click it, maybe. Just thinking about it. There it goes. So even there, if this would have kept going back to all-time high, well, what price was that? Like 200. And so you had a 50% return if it just had retraced itself over the long run back to this 300, Now, I don't think the valuation was that great there. You were still paying like now you're getting into where you could make the real money. There's just more cushion after it bottoms, more time you can come back. If it turns out it's a long-term success and just a minor blip and they make adjustments and all that. But in the meantime, if it doesn't, these earnings could fall 50%. I mean, the market's pricing in a 50% earnings decline, basically. So if that happens, the market will get even more negative. It's going to scare anybody left. I mean, anybody that bought this stock in the past 4 years is under more than that. Anybody that bought this stock in the past 6 years, basically, is underwater. So that usually creates a situation where there's not very many happy investors, and they eventually will just they take all the pain that they can take and they sell, and that can keep going on if earnings fall for the next, say, 2 years or 3 years before they eventually bottom. That's not usually like a fun thing to be a part of as an investor. I have such a small position that it just depends. I mean, I'm monitoring it. It might get to the point where I sell it, but I wouldn't sell, just because next year's earnings are negative. I wouldn't sell necessarily because of that. I'd probably give it a little bit more time. Usually I give these 3 years. And so if you think about it in those terms, that could be a negative year this year, a negative year next year. And then by then I would want to see some sort of light at the end of the tunnel, not completely, but I would want to see earnings trajectory change or revenues or whatever I'm looking at. Or I would decide that the business is truly a disaster at some point along the way, and there's just no way they're going to be able to fix it because of competition or AI or whatever it turns out to be. So that's an outcome potentially too. But to buy now and to sit through a 50% decline over a couple years potentially, probably not worth the potential upside. I mean, maybe. I mean, it would have to, a 50% downturn is the same as 100% recovery, pretty much. So, in the way I think about risk reward, I'm not going to get too deep into that. But for me, it would need to get up to that $200 mark, up here. So you think, what are the odds that it's going to get back up to $200? Compared to the odds that it drops to 60 right now. I mean, to me, the odds of 60 are probably even a little bit higher than it recovering, unless it completely blows out expectations over the next couple of quarters and the short sellers get crunched, and then you could see that 100%. You probably almost saw 100% decline from trough to not quite. So I just think there's probably more downside risk here given what we know than upside, and I would just be cautious and wait for the technicals to improve. All right, no math, no valuations, because normally these are valuation videos, but there's no valuation because we don't know what earnings are going to do. Yes, the history is good, but you have to be aware of when things really could change. Like you have to differentiate. Is this, if I could identify exactly the reason why the stock price is down and I knew the business well enough to know that wasn't a threat, I would be a buyer, but I don't know it well enough to do that. So no math, no valuation work. Now we need to look at the technicals, and we care about the fundamentals because we want to know what earnings do, but the problem is we don't know what they're going to do. So hopefully you found this useful. It's something to think about, potentially a strategy to adopt if you're interested in buying it. And so that's my thoughts on NICE. Thanks for asking for that one, and I'll see everybody later.